Hi, everybody. Welcome to today's episode of FinTech Fun Talks. We have an exciting guest. And for those of you that are just joining the podcast, we are Copper Canvas Ads Agency, and we specialize in helping those in the FinTech industry scale their revenue. Today, our guest is Paul Gallagher, and Paul is the former COO of Thread Bank. Welcome, Paul.
But thanks for having me.
We're happy to have you here. Thank you. So, Paul, let's start with just some of the basics. What exactly is a sponsor bank, and how did Thread Bank fit into that ecosystem?
So, in the world of embedded banking, where a third-party software platform is interested in having bank accounts accessible through their platform or payment services, they either need to get licensed as a money transmitter, money service business in whatever jurisdictions in which they're doing business. So, if they want to have a broad national profile as a web-based digital player, that could be all 50 states and Guam and Puerto Rico, District of Columbia. All of those jurisdictions will have money service business, payment transmitter, licensing regimes. Partnering with a bank enables them to bypass that licensing requirement, where the bank assumes the regulated functions of holding other people's money, operating ACH and wire payments and card payments. Thread Bank was the result of recapitalizing a little East Tennessee bank in 2021.
There's been a noticeable shortage of sponsor banks recently. What do you think is driving that?
Well, it's been an interesting time. Really, during the last administration, politics aside, there was a lot of focus on fintechs in this construct of you had the fintech program. Often there would be what was known as a middleware provider. Companies such as Unit, Synctera, Treasury Prime, Bond was also a player in that space, where the middleware provider was trying to be the, for lack of a better term, the easy button between the fintech program on the one side and the bank on the other side. And there was a lot of concern about regulatory accountability. So zoom out, even before Silicon Valley Bank and some of the other noted bank failures in 2023, um, there was limited capacity in the industry for um, the ratio of programs needing sponsorship and banks was out of whack. There are not a lot of banks that have waded into the space of being fintech sponsors. And so that was actually one of the driving reasons for Thread to get the capital and the talent around the idea of recapitalizing a bank to do this, was that there was a perceived lack of capacity
Yeah.
in the industry and not enough players doing it well. And I'd say the chief reason for the ongoing lack of capacity has been regulatory, with the keen focus of the regulators that only ratcheted up as there were some big bank failures in 2023 that really were unrelated to this fintech business models. What Silicon Valley Bank was doing from a risk perspective, other than the fact that they were banking VC funds and private equity funds and had were considered a technology bank, had very little in common with the model of being a fintech sponsor bank, where SVB had single clients. Let's say a VC fund or private equity fund might have $400 million in a single account that could leave the bank with an online wire originated and processed in 5 minutes. Um,
Yeah.
there was a number of underlying causes of just balance sheet mismanagement, mismatching of maturities that caused the risk that led to SVB's failure. But the regulators got egg on their face. They had to pay out a lot of money. They didn't get ahead of the risk of SVB before the bank failed. And I think there was a bit of an overreaction
Mm.
that caused an even more intense focus on what these fintech sponsor banks and the fintech programs were doing, even though there was, based on the pure size and financial exposure, there wasn't systemic risk to the banking system. Thread Bank still poses. Thread Bank could vanish overnight so long as the depositors were made whole. There's no
Yeah.
systemic risk. And when you look at these fintech models, one program on Thread might have a few $100 million, but that's spread across hundreds of thousands of accounts with an average account size of less than $10,000. There really couldn't be a run on the bank that would look anything like what happened to SVB if one program went away. If the program ceased to exist, it would take a long time to unwind. The bank is still responsible for those depositors. So It's a long-winded answer to why there's lack of capacity, but I would say the underlying cause is the difficulty of the regulatory compliance aspect of it, and the fact that certainly in the previous administration, and it remains unclear. I mean, there's an expectation things will be easier in the current administration, but that is still working its way through. Um, in terms of what's going on in bank regulation, and particularly in this corner of regulation around fintech sponsorships and innovation. And some of the things that we're seeing with the CFPB are actually probably counterproductive. From my perspective, some known bad actors are just getting a free pass, or like I said, we're not pursuing this anymore. And like those are some like things that probably need to be pursued.
Yeah.
And what we really need, and I think one of our consistent concerns at Thread Bank, I don't speak on behalf of the bank anymore, but was just, hey, like, let's have clarity and have like an orderly rulemaking process rather than playing gotcha in the course of an exam and say, like, we think we're complying with the regulations as written, but an exam team just doesn't like what they see. Let's have the orderly process of proposing regulations, putting it out for public comment, adjusting based on public comment and public hearings, and publishing final proposed rules with an effective date 6 months in the future so people have time to get the policies, procedures, talent in place to comply with those, as opposed to creating regulation through enforcement actions, right? And there's a huge diversity among banks and the programs they support around clarity of roles and responsibilities.
Yeah.
Regulators always going to look to the bank to be accountable for regulatory compliance, whether it's BSA, AML, IP, KYC, UIB, fraud, but whether it's the first line responsibility sitting with the fintech partner or with the bank, all that needs to be well defined and documented, and there needs to be ongoing oversight and testing and governance and auditing around that. And it takes a lot. I mean, it's expensive to do it right. You've got to have a lot of talent in the systems and oversight capacity to do it.
It is something that's quite complex. I think that people on the outside don't necessarily see that, and rightfully so. They shouldn't, right? We should be making it as streamlined, as simple as possible for, the cardholder. But it is quite a complex industry in general, and especially with regulations. And they are here to protect people. So not knocking regulation at all, but again, just complex. Something that you and I talked about last time we spoke, you said that you're seeing fintechs acquiring banks out of necessity. So, talk a little bit more about that. Like, what are the risks when a tech company steps into regulated banking without the proper experience?
Well, there's a number of things going on there. I think that's one of the things we'll see in the current administration. There are some novel charter types, and there was a real um, drought of de novo bank formation, certainly during the previous administration. But really, it's goes back further than that, where it's just takes a long time, very expensive to start a new bank. So that is easing up in the current environment. And yeah, so you'll probably see both fintechs trying to secure a de novo bank charter, or kind of doing what Thread Bank did, finding an existing community bank that is kind of going sideways, and can be
Okay.
acquired, or basically through a recapitalization, get control of the bank by overwhelming the existing shareholders and getting control of the board. That can be a faster path, but it's less clean because then you're picking up branches and people, and um, rather than just focusing, having a laser focus on your fintech strategy. It's like, well, what are we going to do with these branches and our community bank footprint? But there are trade-offs there. I think the challenges are some of the more mature large fintechs are getting the right kind of advice from a compliance and legal perspective, fraud mitigation perspective, that they know what they're getting into,
Yeah.
and staff things appropriately to manage the risks appropriately, and handle regulatory compliance. The challenge is if there's sometimes a mindset issue of like, we're the smartest people in the room because we write this beautiful code and have a great user interface, and all the bank stuff just takes too long and creates too much friction, that we'll do it better. Banking is hundreds of years old and has some truisms about managing risk and capital requirements that um, is tends to not align well with a pure tech mindset. So
Right.
And the de novo, if you look at like one of the biggest de novos launched in the last 15 years is Varo. And that has not, and they've got like they've had incredibly talented leadership and they've struggled throughout. So it's, doing the de novo approach, um, as a neobank or, or another, or if you're part of a different software strategy like Toast, Toast
Yeah.
is a Thread partner. Yeah, actually, Toast is one where I would probably give them credit to do it on their own. Not that I think they should, but they are a public company that's got a clearly defined vertical. They really know their customers. They know their space. They're accustomed to doing due diligence on their customers and managing risk. That's the kind of company that could probably figure it out and do it well. But I think that some of these smaller companies are probably better off partnering than trying to acquire a bank charter and do it themselves,
Hmm.
or acquire an existing bank. Recap.
Yeah.
Recap.
Yeah. You had mentioned the disparity, and this is just a normal thing, right? We can't be everything to everyone, but the disparity between the knowledge base that you might have in banking and the knowledge base that someone might have who's worked in tech for a long time. And so when you try to bring those two together and have a combined business model, the cost of mistakes can be really high. Do you have any examples that you can share where poor understanding of banking fundamentals led to major setbacks?
Well, I mean, there's been a lot in the headlines. If you follow the space, so you look at the Evolve Synapse a situation where, and I don't want to weigh in too deeply on that, but Synapse uh, was focused on removing friction and being fast, and there may have been a lack of oversight or deep understanding of all of the money movement that was going on. And I think those are another wrinkle to this whole model with bank partnerships is the FBO construct. So in many of these situations, particularly with a middleware like Synapse, which is in bankruptcy, or Unit or Synctera, where they're providing a modern ledger,
Mm.
and then the actual to keep track of all of the money movement in and out of the accounts and transaction history, and then the actual funds sit on the bank side on a legacy core in a FBO account or an omnibus account. The recon accountability on that is is huge. Things are still evolving on some of the banks looking at moving to real time cores
Yeah.
so that you mitigate the timing differences. A legacy core can memo post throughout the day, but then it processes overnight. It's just so these models can quickly get very complicated. Where you've got to if you have differences, you've got to be able to account for where all the money is. If you're out $1 million
Mhm.
overnight, you want to be able to articulate exactly where the money is all the time, and have those reconciliations well managed so that those things can spiral out of control.
Yeah.
So Evolve Bank is definitely one of kind of the poster child for what's going on. And it's not just Evolve. There were others involved with that Synapse Lineage Bank. And the ongoing resolution of that, of customers are still claiming they're out money. And so I think that's, that is a great example. And I think that, there are others, that are out there in the public domain and some of the consent orders where the processes were not just battened down sufficiently,
Yeah.
whether it's through staffing, technology, ongoing oversight to
Mhm.
really make sure things were buttoned up. And tech companies are focused on the software, not the operational processes. And so it's a combination of all of those things.
It is. They go hand in hand. And it's been a really hot topic lately, the real time transactions and funding, but there's still a lot of ground to cover. And when the ultimate goal is to make sure that you're protecting people's money and identity and all of those things, you need to take it a step at a time and you need to make sure that all the bases are covered. So let's go into our next question. What kinds of metrics or assurances are investors looking for before they back sponsor bank dependent startups now?
Wow. I don't have a easy answer for that one.
Mhm.
Yeah, I think we're living through a very transitional time. One of the things we saw starting really in 2022 as the rate shock started happening interest rates started going up and the cost of funds is no longer free. A lot, if you go back even further, 2020, 21, during the pandemic, huge VC funds were raised and deployed in the fintech space. And that was a time when the industry got sloppy.
Mhm.
And you saw a lot of inexperienced people getting funding and inadequate capacity in the banks. That's also when a number of those middleware providers launched with big capital raises, big valuations. All these founders thought they were going to be billionaires. And there was pressure on the sponsor banks to loosen up the rules and just say, oh, yeah, we as a middleware provider, we've got this. We're handling BSA, AML compliance. We're handling your third party risk management program. Bank, you can just sort of, go take a nap. And that was not the case. Rates started going up rapidly. And the funding tap dried up, and you saw some of the less serious players in the space exit, fail, have a down. The ones that are survivors who had to readjust that, change their business models, readjust expectations. They may have had a down round. And I actually think while painful, I think it's probably healthy for the sector. So don't have my fingertips on the pulse of like how many of these new models are getting funded. And there's just a lot going on right now in terms of like AI and
Yeah.
crypto. When you go to conferences, you realize what the theme du jour is. Like everybody's got an AI strategy one year, and the year before, everyone had a crypto strategy.
Yeah.
But in terms of from an investor perspective, we're still in a very heads down period of not seeing a ton of new entrants. Some of the more mature entrants like Chime filing for an IPO, but others just, grinding it out, trying to see a path to positive EBITDA, and, earning and, getting the cash flow into their last funding round valuation. So we'll see. I haven't seen many signs of, and a number of the incumbent sponsor banks that were kind of at the margins really scaled back or exited in 2023, 24 as well, basically saying this is too hot for us to handle. We're not prepared to make the investments we need to satisfy the regulators. So some were just kind of working out what they had, and others have pursued a much more limited strategy. I would say I put Blue Ridge in the former camp and maybe Piermont in the latter camp. They're continuing to do things, but on a more limited way. Um, and haven't seen a lot of new entrants into the space until the regulatory environment has clarified it.
But a lot of change and a lot of people exiting it in very recent years. That's interesting.
Yeah, I do think the thread will do well in the long run and is doing well currently. Like they're
Mhm.
profitable and growing. So I do think there's been a bit of um, a moat built in it. Those who power through this
Yeah.
period will have a better competitive moat
Yeah, they
as a
absolutely will.
result of what they've had to go through to survive, both on the fintech side and on the sponsor bank side.
The old adage of the cream rising to the top. Like you see it in so many different scenarios, but especially in technology. I look back at some of the interesting things that we had available to us early in the days of technology when with music specifically, right? We had laser discs and different things. And it's like, yeah, they're all cool, but which one is going to rise to the top? Which one is going to end up being the one that people adopt most? And so, yeah, you see that with throughout the world and all these different types of
Well,
technologies.
and there's an element of that which does not kill us makes us stronger, right? If you survive the bad times, and also I think that if you look at, I went to work for Silicon Valley Bank from Wells Fargo in 2011. It was sort of just as things were starting to come out of the financial crisis. And I
Yeah.
remember interviewing with a guy named John Gina, who's now at JP Morgan Chase, but he had accountability for the private bank, which is where
Mhm.
I was going to work at SVB. And he said, the ground that he said like the wealth that would be created for people who had their heads down the last 2 or 3 years during the financial crisis is going to be off the charts. And that was Facebook, Square.
Yeah.
Those companies were all doing the hard work during the difficult times, and those predictions certainly have played out. Google and all of those companies were going through significant transformation during those difficult times. So I think that there is some truth to that. That the people who the times of retrenchment are where a lot of the important work gets done.
Mhm.
That really pays off handsomely later.
It definitely does. I wanted to get your thoughts on fraud. What kinds of fraud are the most common in the sponsor bank world?
So overall, it's first party fraud.
Okay.
So that is where what I observed during my time at Thread was that the customer of the fintech program is the problem rather than the customer getting attacked
Okay.
somehow from without. There were those other types of fraud, and there's some different characteristics. And I would say that ultimately, despite everything going on with synthetic IDs and AI, it is still human behavior. Typically, victims contribute to their own problem. Yeah, so people fall for it and compromise their accounts or their credentials. And I would also
Yeah.
say that the fraud characteristics for vertical programs, I talked about Toast, where Toast is in the restaurant business. They have a full scope restaurant management software platform for order entry, kitchen management, and payment. Their merchant card payment system. So they really know their customers. And if you compare that to a more horizontal play, I won't name any specific programs, but there are these broad programs that provide accounts payable, receivable, accounting integration for a whole swath of small business. It could be a restaurant, could be a bicycle store, could be professional services. They have no way of really knowing their customers. They will have digital filters for validating the existence of the business and they'll do their beneficial ownership screening and they'll have the right technology tools to do KYC, but they're operating at a scale where they can't possibly do what I would call enhanced due diligence at scale, meaning I'm going to go look at Christie's website and click through 4 layers of that website and see where it lands me. And does the third click just give me gibberish and
Mm,
nobody's home? Or can I actually go buy something and have that fulfilled? Or is this business, does she have a real operating address in downtown Salt Lake City, or is her address at some registered agent in Wyoming or Delaware?
right.
So, that level of thoroughness is difficult when your customer base looks like the bar scene in Star Wars, right? All kinds of freaks and oddballs,
Good analogy.
as opposed to "Hey, these all look more or less alike and we have expertise and it's sort of flagging something that doesn't look right. So that's a difference. So generally, as the sponsor bank, we gravitated, if we're looking at a new program, we'd skew in favor of a vertical where the program itself has a high competence in knowing their customer.
Yeah.
And that filters out a lot of the problems right there. And then where we see a lot of first party fraud, there'll be a fraud ring that's kind of someone's masterminding this whole thing,
Yeah.
um, and hacking someone's email um, through a phishing scam. So someone will click a link or open a PDF that they shouldn't, not really realize that they screwed up. All of a sudden someone is lurking in their email, seeing what they're doing. And the
Mhm.
big targets for these things can be things like law firms and escrow companies, real estate attorneys, because they're big dollars moving for real estate closings. That's what seems to be common. Sometimes customers of like life insurance companies who are making premium payments or borrowing against their policies, that kind of stuff. The prototypical use case is the real estate attorney gets hacked. They have a customer who's closing on a property next week and they send bogus wire instructions. So the bad guy is lurking in the email and goes in and alters the wire instructions. You get this email and you think it's from your title attorney. It is using that exact email address, right? They are inside that company's Outlook system.
They've been able to hack it.
Right.
Yeah.
With all of the technology going, most of these fraud situations are just like careless human behavior is the cause for 90% of the problems. The rule of thumb is if you get wire instructions in an email, you call the person who sent you those instructions at a known number,
Right.
right? And say, Bob, got this email from you with the wiring instructions for the $200,000 you need day after tomorrow. Did you send me that email? Are these, and read back the wire instructions. Is this correct? And most people don't do that, right?
No. Because we've been trained to look for odd email addresses, and we know to look for that type of thing. But if it's coming directly from their domain, of course I'm going to feel like, yeah, this is from them. So, a new layer of fear we have to be
And
aware of.
then what the other side of it is in these elaborate scams
Mhm.
is money mules are recruited. These are sometimes people really sometimes these people know what they're doing, and sometimes they're just
Mhm.
useful idiots, or they've been
Paid
duped.
courier type of thing.
So the money mules, they often prey on, older people, usually financially marginalized people who don't have a lot of
Mhm.
money, but sometimes it's a, lonely hearts scheme. I'm some old guy and, I think I'm emailing some beautiful young woman who thinks I'm wonderful. And this can take weeks to play out and say, oh, I just need you to do me a favor. Someone is sending me this money, but I need you to receive it and then send it on to
Mm,
these other people, and people fall for that. And then the money mule is typically someone who has a clean record, right? And they'll open an account with a fintech program. They'll go through the whole persona verification with the selfie and a photo ID. And use their real address, and then they'll receive that, and they'll be, oh, for your trouble, you can keep $2,000. I really
mm.
for your time and inconvenience. So, it seems too good to be true, but I need the money. Like, why not? So, and that, and sometimes these people know exactly what they're doing, and many times they're people who've just been recruited, tricked into it.
And they
Uh,
need money. And it's easy to choose to overlook any red flags if you're in a state of desperation. And I think that they know how to look for people who are in tough situations.
so that's the money mule side of it, and that's a bit of whack-a-mole. In that you could have technology that is sniffing for these patterns of this account has only been open for 30 days. They funded it with $100 and haven't done anything for 60 days, and all of a sudden we have $100,000 wire coming in. Let's put a hold on that, and hopefully we can prevent that money from leaving, and actually just slow it down to see if this is legitimate or not. And call the sender, to see if they knew where the money was going, all that kind of stuff. But oftentimes, it goes through, and then the victim is not a customer of Thread or a fintech program. You're just
Mhm.
someone out there living your best life, you think, trying to buy a house, and you just sent $200,000 to a bad guy.
And it's
And
just
then
gone.
the Thread bank and our fintech partner get caught up in trying to resolve that. There's a whole procedure of sending messages through the Fed and following up with a hold harmless letter, basically your bank telling us, please try to get the money back on a best efforts basis. And we're not going to hold you accountable for any shortage, or please
Hmm.
just do your best to try to get it back. Because the accountability in the system lies with the person who sent the wire or the ACH.
Right?
It's not the recipient bank's fault,
No.
although the recipient bank has a lot of reputational risk in that because of the perception that we're banking bad guys, right? We're banking
Yep.
people who steal money. That's that's where I saw the bulk of the challenges in these very heterogeneous programs that couldn't possibly do adequate due diligence on every single customer coming through. And there is a incentive mismatch. They're being measured by VCs on traditional software metrics of numbers of, and they are not incurring those losses, right?
Right.
The losses are kind of a put option to the victim that banks at another bank. I think that is an area where an incentive problem that needs to be addressed with those types of programs.
Yeah.
I think the regulators are starting to look at that as well and trying to force the level of scrutiny that you would go through if you were opening that account, sitting in a bank with a customer service rep, presenting all your business resolution documents, your photo IDs, and they would be asking you, like, what's your expected activity on this account? Are you going to be receiving? Yes, are you going to be sending
Yeah.
wires, receiving wires? What's the nature of your business? And and again, if someone's just signing up online and using a registered agent, all that kind of stuff, it's a very different standard.
So, Paul, With this fraud, are there any tools or technologies that you believe are game changers or that can find a balance between user experience and safety when it comes to preventing fraud?
I do, and I think there are a number of players in the space that I think are starting to look more holistically at fraud and BSA AML. We didn't really talk about BSA AML, but that tends to be the biggest hot button of the regulators in this space of monitoring transactions for compliance with BSA AML. And BSA AML is very related to fraud, but it's not fraud.
Yeah.
I mean, BSAML is articulated by statute and regulation rather than do we have fraud victims out there? Many BSA alerts that, upon investigation, are problematic are also fraud, right? So I think that there are a number of players in the space, some with some very talented software minds that understand banking and fintech. Uh, Being Solar at 21, I think the ones that are starting to look more holistically at customer activity and applying AI agents. And I'm behind the curve of getting smart on the AI application of AI in the space, but I think that will help a lot.
Yeah.
I do think that some amount of friction is important, and that's another area where the fintech program and the mindset of the tech side of fintech, as opposed to the banking side of fintech, is all about removing friction on the one hand, whereas most fraud mitigation techniques involve slowing things down and
Mhm.
taking time to investigate. And so the whole like real time, fast settlement, speed is inherently riskier. And I think that they're parsing things out to like real how often is it that you need the money immediately,
Yeah,
especially if it's, a large, it's one thing if it's $500, another thing if it's a 500,000 bucks.
exactly.
That, um, that if anything in traditional, fraud awareness is like if there's a artificial sense of urgency, that's a red flag, right? Some of those transactions should have some speed bumps built in my view. Particularly if you're seeing some other things going on at the end of the day, having some friction in the system that has experienced human judgment and asking questions, even picking up the phone and calling a counterparty and saying, before we let this $500,000 go, want to confirm that you have sent it to the place you thought you were sending it.
That really goes full circle to the real-time payments and settlement and just why we're not there yet. We've got to have these things in place again to protect people. Paul, thank you so much for
Yeah,
your
and people just need
insight.
to understand that on real time payments, whether it's a traditional wire or FedNow or RTP, it's you're playing with a loaded gun, right?
Yeah. And
And
there's a lot to be lost.
right.
Well, thank you so much for joining today. We really appreciate it and all of your insights and the suggestions on how people can protect themselves from fraud. Thank you.
This was fun. Thank you, Christy.
Thanks for watching our podcast today. I'm Kristen Nielsen. I'm the owner of Copper Canvas Ads Agency, and we partner with fintechs to help them scale their business within a 12-month period. I've been in the industry for over 20 years, and I've seen how saturated the market can be, and therefore how difficult it can be to make your business stand out in a sea of other fintechs that may look similar or maybe even slightly different. But how do you make yours stand out? How do you get your message to the right people and those with high buying intent? That's what Copper Canvas Ads Agency is here to do. We are a growth partner, and we take a deep dive into your business to really understand what your strong points are, where there may be areas of weakness, and how we can fill those areas of weakness and create a plan to move forward in a strong way and really scale. So if you are interested, simply go to our website, coppercanvasadsagency.com, and schedule a time. There are buttons right there on the front page for you to book a time, and then we'll love to talk to you and see what we're able to do together.